Good morning and welcome to the Post-Monetary Policy Committee press conference. The Monetary Policy Committee of the Central Bank of Kenya met yesterday, Tuesday, September the 28th, and today, Wednesday, September the 29th, we have our customary press conference hosted by the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge. As is usual, we shall have the Governor making his statement. After that, you're able to come in with your questions, and the code to enter on Slido, SLIDO, is MPC09, hash MPC09. Please put in your questions there, and as usual, introduce yourself by name and institution. Without further ado, I want to hand over to the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Good morning, friends, colleagues, wherever you are. Welcome to this briefing following yesterday's MPC meeting. And the MPC Monetary Policy Committee examined developments since our previous meeting in July, particularly against the backdrop of the past policy actions and the evolution of the COVID-19 pandemic. So today we will cover some of the principal issues that the MPC considered, and I'll begin with the global developments and then move over to domestic developments with some specificity as we go through the presentation. The first is the global developments, and here we noted that we noted the progress in the vaccination programs around the world. However, vaccine inequity continues, and further action is needed. That is, there is proportionately less vaccines coming to us in the, let's say, not the advanced economies, and a lot of vaccine is available in the advanced economies. And against that, we know that no one is safe until everyone is safe. So it is important to maintain or to actually get better equity, higher numbers in terms of the doses and indeed in terms of vaccination in our countries. There's also the reopening of economies, and these are in the advanced economies, and that was noted, along with the risks that have been presented by the Delta variant of the COVID-19. And there were reactions to that, as we all know. At the beginning, there was quite some concern about it, but I think that has now been muted and brought up pretty much under control. In Kenya, I think slide number 1, please. This slide shows the general outcome in terms of around the world, and Kenya's numbers are there. But I think important to note that was actually on September 27th, I believe. So the numbers have improved a little more. Yesterday's numbers were 3.7 million Kenyans have been vaccinated, and which represents about, or the numbers that have been fully vaccinated was 894 compared to the 889 thousand that is being shown there. In any event, this represents about 3.3% of adults, Kenyan adults, have been fully vaccinated. Also, for you to know, the positivity rate as of yesterday was 4%, which means that the numbers in terms of infection numbers have come down, and we have a much greater chance of really destroying this pandemic, or really stopping the spread of this pandemic. But vaccines remain the way forward, and that should be encouraged at all times. Then we talk a bit about the global developments, and I think here we noted that first, we don't have any new seriously, or let's say, any new projections with regard to global growth. So the last ones that we discussed in July are still valid. And we expect the new view projections in about 2 weeks. At the same time, we've noted a strong rebound, which continues in the advanced economies with some bumps related to the spread of and control of the Delta variant that was spreading recently. So global growth projections remain as before. In 2021, 6%, and in 2022, 4.9%. We expect this will be revised, perhaps even maybe revised downwards given the risks that are there, but not by much. But anyway, let's wait 2 weeks and see where we go. But of greater concern is inflation dynamics in the other economies, the global in the global economy, as it were. This has been heightened by supply bottlenecks, so difficulties in getting products where they should be, not necessarily finished products, at times actually the components. So for instance, semiconductors, which are needed not only for computers, but also for things like motor cars, etc. So having problems delivering new cars because you don't have the semiconductors to go with that. And shipping as well. There's been constraints, particularly in the major ports in the US and also in other parts of the world. And indeed also, for instance, in the UK, there was this concern about truck drivers, lorry drivers, which has led to significant problems on, let's say, the petroleum industry. And so people cannot quite get petrol in your local petrol store, petrol shop. So that is a big concern because clearly it will lead to significant increases in pricing of products. At the same time, the second element on this is the increase in global oil prices. The fuel prices in the international markets has risen quite a bit. And all benchmarks for crude oil are pretty much at recent record highs or recent highs. That is a big concern because it will have knock-on effects on most other products. And also there are weather-related concerns, and the most recent of this is obviously in Brazil. We monitor Brazil quite a bit, partly because they are also significant exporters of coffee. And we in Kenya, obviously, this is an important industry. But the point is that Brazil's these weather-related, well, actually they have had drought, and therefore they are having problems in all the things that they are growing, including sugar, including soybeans, etc., and coffee as well. So outcomes, nevertheless, in the advanced economies have been quite surprising, meaning inflation numbers, at least the benchmark inflation numbers, have risen quite sharply. And interestingly, just one number to put out there, the US production price inflation earlier this month was above 10% for the first time since 1981. You have to go back to 1981 to get numbers like that. And of course, there are other benchmarks that are followed, but I think the point here is that this is a big concern, and there's been a lot of conversations as to whether this measured inflation that is now coming through is temporary or permanent. But the big concern is, we, the central banks, are we ready to take policy action if this becomes a problem for our economies? So the fears are that in general terms, in terms of what is happening around the world, is that there may be central banks and other policymakers may be forced to have very sharp, to tap on the brakes very sharply. But it won't be tapping on the brakes. It will be more like a handbrake turn, sort of slamming on the brakes. There are also concerns about credibility. That is a big concern for central banks. And indeed, there are also concerns that there is greater potential for an accident in the markets. So What is just appears to be a problem on inflation is actually not just inflation. It has other implications which clearly the central bank fraternity are looking at this, and we expect that correct and timely action is put in place. So that's on the global. Then moving to domestic developments and staying with inflation, the dynamics there have remained that, and now we move to slide, maybe slide number 3, I believe it is. Slide number 3. I'm sorry, I've got the wrong slides. Yeah, I brought the wrong slides. No, it's okay. Yeah, I brought the wrong slides, but that's okay. So actually, slide number 3. Yes, this shows the inflation pressures that we have at this moment. August, the latest number is 6.6, and you can see from that the big drivers of inflation was fuel, and that is really the brownish, the dark brown, which you can see was at 9.2. Oh, thank you. 9.2, and the food was at 10.7. So really that is what has been driving our inflation. You can see non-food, non-fuel has been below 3%. That's the green. So the question is what's happening on the fuel and indeed on the food. I think on the fuel, the answer is simple. We have slide number 2. It shows the Marban oil. This is our benchmark oil, we in Kenya. And you can see how it has grown, or rather how the price has increased. And now, as of September 22nd, was $74 per barrel. Actually, yesterday it was $78.3 per barrel as of yesterday. So you can see this has grown, has actually risen quite a bit. So that's on the oil part. But in terms of the food, there is another slide. I don't remember the number. Yes, there it is. So this shows the contribution to overall inflation, and you can see the various components, right, that are there. So the point here is that, and the concern here is more in terms of weather, and also somewhat the supply of those products to the various markets, but it's largely weather related. One more thing to say, staying on the theme of prices, the tax measures in the finance bill will, of course, and indexation will continue to make their presence felt. And the contribution, as we said last time, we calculate the contribution to be something in the order of 1.78 percentage points to overall inflation. So what is the bottom line? The bottom line here is that we do understand that monetary policy cannot overcome the direct concerns from oil price, supply chain, and weather. So we do understand that. So as policymakers, what we do is we'll look at the second round effects, and those are the ones that we do have control over. In a sense, our policy will be effective in terms of constraining the second round effects that would go through, say, from oil, supply chain, or weather-related factors. So the MPC thereby indicated that it will monitor and stands ready to take whatever action will be needed, particularly to deal with the second round effects. Then the next item is on GDPs in general, or should we say the overall economic numbers, national income. And we are aware that the KNBS, the Kenya National Bureau of Statistics, released the 2020 GDP data earlier this month. And along with the release, or embedded in the release, was a revision in the numbers. And this is to align itself with, align the numbers, the GDP data, with the current structure of the economy, and indeed to use newer, better data sources, and to correct any errors that may have been there before that. So this is the so-called rebasing of the GDP data. And I think you've already been exposed to that, so I will not mention much about it. But I guess the one point, there are a few points I would make. In 2020, from these numbers, the year of the greatest economic shock since the Great Depression. And so we have to understand the outcomes against that. And global economy contracted by 3.2%. It's been a long time since this happened. And for the 30 countries that account for 83% of world output, only four had their economies expand. Even the US contracted by 3.5%. So that's the backdrop. We could talk about other countries in the neighborhood, but I think that suffices. So the outcome in 2020 for Kenya was an overall contraction of 0.3%. So just 0.3% in 2020. So in some sense, this is an outcome of a very big shock, and then the policy measures that were put in place to overcome the shock. Now, it is clear that, yes, we did have measures that, in effect, inhibited the dynamism in the economy, and these are the shutdown measures that we talked about before, etc. But we know why those measures were put in place, which is to stop the health crisis from expanding, right? So I think the point here is that the measures that were put in place, the policy, were quite effective. I think the outcome is clear. Now, which are the sectors that are worth noting? I flagged the sectors that supported the economy that remained quite dynamic. And agriculture is the first of this. It grew by 4.8%. Construction was also quite dynamic, quite buoyant, grew by 11.8%. Health services, 6.7%, ICT, 4.8%, etc. The weak sectors, surprise, surprise, accommodation and restaurants, which contracted by 47%, actually 48%. Education contracted by 11%. Professional services, so think about, for instance, the people that take care of the accountants, the lawyers, etc. So that contracted by 15%. So those are the sectors that, in a sense, dragged the economy down. And I think going forward, we need to look specifically at those sectors. So having said that, and I'll move rather quickly, we are now talking about the first cut of the projections for 2021 with the rebased data. We've done this, but I think the first thing I would also say here is that the preliminary estimates for Q1 and Q2 will be out shortly, I'm told in a few weeks. So we haven't had a chance to use this. So we'll have to revise this based on those outcomes. But we've looked at the leading indicators as we know how. And so in 2021, our first cut is a growth rate of 6.1%. And in 2022, we expect the growth rate, the economy to grow by 5.6%. But I think the point is that this wasn't a mechanical exercise. So we went through sector by sector. But before going to these specific sectors, I think I need to tell you some about the overall. And here we begin with the market perception. And I want to go to slide number 13. Mind you, we have done the regular surveys, market perception, CEO surveys and also the hotel surveys, and this will be published by Monday, possibly even by Friday, but will be published on our website definitely by Monday. So first here, from the market perception survey, it is clear that respondents remain quite optimistic. And I think you can see banks, they are 83% optimistic. So meaning of the respondents that were very optimistic, total 83%. And in terms of non-banks also, non-banks 66%. So there is a lot of optimism in the economy, despite maybe the problems related to the lockdown and all the other problems that maybe the producers or the various farms may be facing. Next slide, please, shows business confidence from the CEO survey. And I think this is clear. It shows dynamism about growth prospects. And I think the point here is you can see that the containment measures and the global recovery are seen as good anchors or support for the Kenyan economy from their perspective. And their concerns relate to COVID-19 containment measures, weather conditions, and of course political activity, political noise, if you may. It's interesting that manufacturers, respondents in the manufacturing sector, they remain concerned about the impact or the implications of the rising input prices, most of these imported, but also fuel, etc. Moving on to hotels, just the next slide. Again, just to complete this, we now see that virtually all hotels that were responding have reopened. So there are very few hotels that have not reopened, and those ones are in, the ones we know are in Nairobi. So that's a good picture. And in terms of bed occupancy, next slide please, you can already see some improvement towards the end. Yes, it's a bit noisy and you need to look at it a little more carefully. But I think the point here is that the occupancy is moving higher and higher. We have also seen that the occupancy has been pushed up by most recently the under 20 games that took place here in Nairobi. So there are all those factors, but again, on the whole, occupancy is increasing. I mean, definitely much higher than what it was before, but it is important to see that we are not where we should be, meaning the numbers are still low, but the direction is clear. That's all I wanted to say about that, and I'll now move to a few things. Credit, slide number 17. You can see, and I'll move fairly quickly, credit has been growing. This is private sector credit over the 12 months, 7%. Slide number 20 shows the distribution of credit or the credit growth in the various sectors. This is quite informative because it shows that all the sectors really are getting credit. But now I want to go to specific sectors, and I'll talk about the turnovers, the sales turnover. First is the sales turnover in wholesale and retail. Yes, this is it. And you can see in manufacturing as well. So you can see that, and that's the red. The red is the sales turnover by month. And you can compare it to the black dashed line, that is 2020. But perhaps even better is the blue, because you know the dip represents the decline that we had during the shutdown, etc. But you can see the growth rates are high, 10.5, 7.6, etc. This is on wholesale and retail, and it is an important sector as we know. Manufacturing, a particularly interesting sector. You can see it's growing by, in terms of turnover, manufacturing turnover, it's growing by north of 15%, so 16, 17%, which obviously is reasonable to, well, indicates dynamism in that sector. Accommodation and food. So you can see that the red line is well below the blue. The blue was 2019. But what is important here is that we are getting out of the dip that we had in 2020, the dashed line. So again, some dynamism is beginning to come back. This is definitely not, I mean, we are still way below where we could say that we are comfortable, but I think it's important to note the direction. Transport as well is on that slide, and again, useful to see the red. Now the peak there, I don't remember the reason, but I think well, maybe statistical reasons, but I don't remember why the peak in 2020. The reopening, yes, but I don't know why the reopening. Anyway, let's leave it. We can have a conversation outside. Then moving on to electricity, again moving quickly. So this is the electricity, I don't know the number. Yes, that is it. So you have the consumption by large and small consumers. Again, the red is way above the gold of 2019, or the black of 2019, or blue of 2019, depending which graph you're looking at, but definitely also higher than the 2020, which is the dashed line. So we mentioned cement, just for you to know. Again, same picture, growth rates quite high, both in production and consumption. And finally, I wanted to show you cane deliveries, anticipating that it is important for us to maintain our, our production of sugar. And I think there you have the red and a reasonable growth or strong growth relative to 2020. So that is all I wanted. So once we built the leading indicators appropriately, this and others, this is how we got to 6.1% for 2021. I would mention that the one sector to flag is agriculture, and agriculture remains most uncertain, largely because of the rains. Now it's true, there are some parts of the country that are getting adequate rains, and there are also parts of the country where there is drought, and indeed there has been a warning, drought warning that has gone out in the standard way. So I think the point here is agriculture remains a bit uncertain for us at this moment and will be a large driver, but at this moment we are projecting it at 2.6. Moving on to the external sector, exports are growing well, this is slide number 5, and strongly actually. So for January to August, it grew by 11.5%, and with steady demand for horticultures and manufacturers. The graph there, or the chart there, shows it. Tea prices have improved in recent auctions, which is good, and we expect that to be sustained moving forward. In terms of imports, the next slide, imports also have increased by 22.9%. Interestingly about this also is the intermediate inputs. Intermediate inputs excluding oil. And you can see the purple bar, that is obviously much higher than the blue bar in 2020. So it shows that actually manufacturing is working. Again, we keep coming back to the issue of manufacturing, meaning there is actually some dynamism, also dynamism for manufacturing exports. So that sector is not so comatose as maybe some would have you believe. So that's on the imports. I want to move quickly on other things here. First, in terms of the remittances, actually. So there's a slide on remittances, if you could please show it. Yeah, this is your monthly remittances, and for August it was at 313, which is quite high compared to August of last year. There's a decline from July, but this is seasonal. We generally expect that the seasonality of remittances begins in July. July, the numbers come down, August, all the way to November, and then they pick up again as we get to the Christmas season. But why was July so high this time? Why did it break that seasonality? I think we believe that it is related to the changed education cycle. So people are going back to school, and so money was sent for school fees, material, etc. So we expect it to remain about where it is in August, maybe around there, and then pick up again. But for the year, it will be a significant growth, maybe closer to, well, we have a number, but it will be a significant growth for the year. That's on remittances. There's a slide on tourism, but I think we could, in the interest of time, we could skip it, but it shows that numbers, tourists are beginning to come back. Yes, here it is. So this is tourist arrivals and has improved. This is the blue line. And of course, we are still, as I said, we are still off our highs. And you can see even January, February last year, we are nowhere near that. But I think the point is that, again, the sector is beginning to pick up. So closing on that, going to the current account. The current account deficit, there's a slide on that, please. And it shows that we are now at 5.5% of GDP. Slide, please. And we expect that for the year, we'll end up at about 5.2% of GDP. So that is a slide. And you can see the improvement over the last, well, since 2014. But again, we keep saying that we should be around 5%, and which is where we are ending up. Now, bottom line, this is, we expect significant balance in the FX market, and with the current account where it is predicted. And therefore, we don't expect much concerns coming from the FX market. And also in terms of reserves, we are currently at, what is it? Yeah, we are currently at 9.45 billion US dollars, which amounts to something like 5.78 months of import cover, which we believe is adequate for any potential shocks going forward. So that's where we are on that. Moving then to banking, I'll be quick on this. I think the point to make here is that it remains stable and resilient. Capital adequacy, liquidity, all those indicators are well above the sort of the norms or the requirements. But the point to make, there are two risks that remain elevated. The first is credit risk. This remains elevated. Even as we know that gross NPL, the ratio of gross NPLs to gross loans in August was 13.9%. So that has fallen a bit marginally. But I think the point is we cannot, we need to maintain our focus on credit risk. And this will be shown through NPLs, etc. Secondly, operational risks remain elevated. And this relates, for instance, to COVID-19, the impact of that. in the banking sector, or for that matter, the digital channels. Digital channels are now, that's the workhorse of banking and finance in Kenya. And consequently, any issues around that, like fraud, etc., need to be dealt with, and that is the operational risk that we are talking about. Just for you to know, I think we mentioned this before, with regard to the loans that were restructured in the context of the COVID-19 back in March, the policy that we put out. The policy was simply that any loans that were performing on March 2nd, 2020, the borrower could have a conversation with the lender and restructure it as needed, given the new realities of COVID-19 and the impact of that on the, let's say, on the cash flow of the borrower. And 57% of all loans, 57% of the loan book, sort of total loan book of the economy, of the country, of the sector, was restructured. And at end August, the amounts of these restructured loans that were still outstanding is about 15% of total loans. And of their outstanding loans, 93% of them were performing according to the restructured terms. So the point here is that we are monitoring, and it is something that we want to make sure that there's a good outcome. So as I finish, fiscal performance, we obviously had a robust conversation about this. And the issue here is the bottom line has to be the target fiscal deficit, which is 7.4% of GDP for this fiscal year. And revenue performance is doing very well. So very well. Ordinary revenue, in particular for July through August, those 2 months, the target was 247.1 billion, and the outcome was 251.1, which is 4 billion above the target. And I think that word sounds good, above, so meeting the target. So this is something that I think maybe offers greater assurance of the deficit target that we have. Of course, there's also the other thing, which is the expenditure with regard to the various programs, and two in particular, the Economic Stabilization Program, and also the Recovery Program, which were put in place following COVID-19. So that's what I wanted to say in terms of the discussion that took place. But I think as I finish, there are two things I may want to remind you of. First is the work that we have been doing on digital lenders. And as you know, the bill today is in Parliament, and it is in its third reading. And we expect that this would be approved, and then we'll begin to implement it in short order. So that is one thing that I think we need to tell you. And then secondly, to remind you that as a central bank, we have a lot of material on our website, a lot of material published there. And I encourage you to go look at it. I'm sure we have put together sort of slides with all the covers of all this material, but I think it's best if you go there for yourself. These are just a sample of them. Documents that are regularly or more or less available on our website on a particular cycle. So that is for you. Thank you very much. I'm open to your questions.
Thank you. So in terms of questions arising out of the governor's presentation, we shall start with Kefa Njoroge. He has two sets of questions. And the first one is central banks around the world are easing off the throttle in support or have at least indicated so. What should you expect from our own central bank? And he continues with that question. The Federal Reserve in the US and the South African Reserve Bank have, for instance, indicated plans to revert to a higher benchmark rate as seen before the pandemic. David Herbling from Bloomberg News asks, what will be the impact in percentage points of the recent fuel price increase on September inflation? And then another one from Kefa Njoroge. In bolstering its firepower to deal with any adverse effects, would the CBK consider engaging the IMF on getting a new insurance cover standby credit facility?
Okay, thank you very much, colleagues. So taking them in order, I think it's true the central banks around the world. I explained the first two questions, I think, quite well when I was talking about inflation. But I think not all banks are the same place. There are those that had their foot firmly on the accelerator, so sort of flat on the metal, foot on the metal kind of thing. And this is even had done the QEs, etc. So clearly those, and in particular the Fed and the ECB, they need to begin sort of action early on. Otherwise they'll end up having to slam on the brakes. The risks are clear, so I think I've explained what is it that our own MPC, our own central bank, is looking at. And I think I explained that in the context of inflation. And I think that is to be juxtaposed against the concerns of maintaining some sort of accommodative stance, which, again, I also mentioned in the context of fiscal, that will continue. Fiscal will continue to maintain some dynamism. So I think that is the bulk or the, let's say, the answer that I could provide to Njoroge's question, or Njoroge's questions. Again, South Africa is different, is at a different point to us. It's amazing, we need to look at the structures of these economies. South Africa is not, largely, we are much more diversified than South Africa, their economy, right? They export primary products, etc. And that has its own cycle that they are having to deal with. So I think the point, and also in terms of the pandemic, we are also facing different cycles. South Africa is ahead of us in this cycle, but I think they have taken the blunt. They've been hit quite hard, as you know. So I think each one to his own, but the policies are in that direction. Then David is asking about the impact in percentage point. That I cannot tell you now. But I think I explained the measure of the impact of the measures that we had before. So we can take that offline, but I think that's not something that I have at the tip of my fingertips. Then the question about engaging, Njoroge again asks, Kefa again asks a question about engaging the IMF. And I think we've missed something here because we have engaged them. We are in a program. We are actually at a point of doing the second review. We've done the first review of the program and it went well. The second review will be done and hopefully by the end of the year will be considered and completed. The review will be completed hopefully by the end of the year. So I think we are in that. And if you recall, it's exactly what we said when we started off, which is we do need, this shock is large and we need all resources. So in some sense, it's all hands on deck in terms of addressing this.
All right, the second batch of questions, we begin with Alex Mwangi from NTV. Alex asks, How prepared are we as a country to handle any adverse effects that may arise from a U.S. default? David Herbling again, what is the projected growth in diaspora remittances in 2021? Razia Khan from Standard Chartered asks, the GDP rebasing revealed a weaker growth trend pre-COVID, but the leading indicators outlined today point to a sufficiently robust outlook. Are there any concerns? And finally, Peter Mboro from the Daily Nation, who asks, the governor has been providing worst-case scenario for NPL trends. Can the governor provide one for inflation trends in the country?
Okay. Thank you. So I have a lot of data here, so I have to figure out what data to give out. Okay, so here we are. Okay, there we go. I'm sorry, we do need to be sure what we're doing. Okay, fine. So let's begin. And the first one is the US default by Alex Mwangi. First, let's be clear. I mean, the US default, I guess it makes good headlines and things like that. Has to be understood what that is. The idea is that there is a debt, if I understood you, there is a debt limit that above which, let's say, the US Treasury cannot borrow. So they do have a US dollar, a nominal debt ceiling. And so they are now approaching that ceiling. And the Secretary of the Treasury, Janet Yellen, yesterday said that they have until, they can manage under the ceiling until about October 18. So if they don't get any approval by their Congress, etc., they don't know what will happen because something will have to give. And so how you're presenting it is the US default. So they'll be unable to repay, et cetera, et cetera. I think that's a worst case scenario. I think saner minds, much more, calmer minds will understand that there's no winning. Even if you have a political position, everybody loses. So not only the US, but indeed also the global economy. So I think this would be, going in this direction would actually be cutting off your nose to spite your face. And I think calmer minds will prevail. So that is all I can say. And eventually, in a sense, there's a game of chicken. But I want it to be clear that we cannot continue in this way. And a deal will be struck. It has happened many times before, or it has happened a few times before. So a deal will be struck which will allow the continued operation of government as before. And then there was a question about projection of diaspora. Well, the only one I can give you now is we are projecting something in the order, and we need to tweak this again. We are projecting something in the order of $3.4 billion US dollars for the year 2021. So that's a number. But again, we need to reevaluate this. Then Razia asks about the GDP rebasing. I think what I would say is we have always been concerned about the GDP numbers, not the ones that we had seen before. Even in this forum, we've mentioned this, that the GDP numbers at times are not in sync with the leading indicators. And I think the ones that are now, that we are now looking at, that's really one of the reasons why I prefer to show you all the data in that sense, to show you the leading indicators. Because at the end of the day, why wouldn't GDP be aligned to those leading indicators? I mean, it doesn't make sense. So I think the point I'm making here is that the past we live, right? We do understand there's been some restructuring and things. Also, I would ask you to look at, it wasn't a one-way sort of movement. There are also mistakes that maybe were fixed in those numbers. So I think we are okay in terms of that base. But going forward, let's look at what they're going to give us in Q1 and Q2. There was a question again about worst case scenario. I don't at this moment have a worst case scenario for inflation, but I think I would say that our mandate is price stability. So if indeed we are completely out, if we allow inflation to just surge into the worst case, whatever the worst case is, I think we would be missing on our mandate. So that it has to be understood that that is not a scenario that we are willing to do nothing about. So there will always be an active scenario, which is when we come in and actually take policy action to stop inflation from surging. But again, I have to explain, as I explained rather, that the first order effects or the first round effects, we cannot control that. So we have to, in effect, accept the first round effects. It's the second round effects, the knock-on effects, that actually we can have some impact on. And again, that also through time, etc. So it is, we have certain tools that are useful, but they also take time.
We begin in this round of questions with Charles Moniki from the Business Daily. The governor said that 15% of all restructured loans are still outstanding. How much is this in actual terms, and when should we expect all to be normalized? Which sectors are most affected by these loans that are still under restructuring agreements? From Dominic Omondi of The Standard, why did Kenya decline to participate in the second window of the G20 debt repayment moratorium when debt service costs are still taking up a huge chunk of taxes? Finally, from Monica Kamokwa from Truth FM, in the talks with the IMF, how much is the country expecting and what projects are the funds set to finance?
Okay, so the first question, Charles, those, I don't have them here, I don't have all those details in terms of the Kenya shilling equivalent. My notes were just on the percentages, but we do have the Kenya shilling equivalent somewhere. And you can do a back of the envelope calculation if you could, but I would rather give you proper numbers. In terms of normalizing, I don't know what that really means. But if you mean when will everything be repaid, because actually, as I say, it is normalized today. Why? Because 93% of those loans are actually performing. So unless you say it's normalized when those loans are repaid, so that is the issue. Secondly, you maybe are talking about the others, which is the 7%, 6 point something percent that are not performing according to restructured terms. So maybe they're on watch or they've now sunk into non-performing loans. Well, there is a whole, let's say, process with those loans. So it's not like they've fallen off the table. The banks and the borrowers are still working to make sure that those loans are fully repaid in particular ways. And I think at the end of the day, the normalization will really happen, if that's what we are thinking, will really happen when the economy normalizes, meaning when COVID is behind us. So it is important to again point to where the greatest risks are. And the greatest risk is actually one of continued, let's say, inaction from our perspective as citizens in terms of vaccinations, etc., and therefore maintaining this sort of malaise of COVID or the pandemic within us for much longer. So the question by Dominic Omondi about why Kenya declined to participate. This I would rather you ask, you direct the question to the right office, which is the National Treasury. They are the ones that would give you a conclusive answer here. And Monica's question about the IMF, how much a country is expecting and what projects are that are being funded. I think there are two things I would mention. In terms of the information, in terms of the funding, etc., quote unquote, I think that is at every point when the review is completed, there is a disbursement that is made. And that is really the signal that we have completed the review. In a sense, they put money on the table. I don't have the number. Last time we had disbursement of something in the order of $750 US, I think it was, something like that. And that item, so the next review will probably be something, my recollection is 300, but I'm guessing here. Is it 300? Anybody? 300? Yeah, around 300? Okay, something like that, but whatever it is, it's a number like that. But importantly, you can find the details actually in the documents that are on the website. But in terms of your second part of the question, what projects are funded, etc., I think that one, you need to appreciate that actually, yes, these funds will be used for budget support. But I think it is the government, the National Treasury, that can tell you, that can give you precise information as to how these funds are being used in terms of funding. I think I can also tell you that at the end of August, as part of the international effort to support countries around the world, the IMF made allocation, SDR allocation to all member countries. And we got our share of that, something in the order of $750 million US, the equivalent of. And this obviously goes into our reserves, and we use it like any other reserve. So it is not labeled in any way. You know, money is fungible, so I leave it there.
So the final question to wind up today's press conference or press briefing, again, is from Dominic. And Dominic from the Standard, Dominic Omondi, asks, the CBK can do little with the current drivers of inflation, but will jump in when the secondary effects of these drivers kick in. Which are the secondary effects?
Okay, Dominic, we need to have conversations to sort of appreciate this. I hope you understand. I hope we understand each other about the first part of your question, which is the current drivers, principal drivers, where the inflation is coming from, are things that don't react to monetary policy. That is really the point. It's not that we are sitting doing nothing. It's just that they don't react. No matter how much we change monetary policy, tighten monetary policy, it won't rain. It won't affect the rain. Or it won't affect the price of, imported price of Marban oil. You know, it doesn't work. So that is really the point. So the prices will be passed on to consumers in the usual way. That is the first round effect. The second round effect, I didn't use secondary, I used second round effects. So the second round effect is when that item, let's say the price of fuel, then leads to an increase in other prices like transportation, electricity, etc. So the point there is then we can use monetary policy to actually constrain domestic demand. And so by so doing, there will be less impact on the inflation. So in effect, it's a demand side management. So the second round effects, it doesn't mean that there will be I mean, they present themselves to, let's say, effective demand side management, of course. There are some that won't be affected so quickly. But I think the point here is that from a point of view of the economy, it is the second round effects that we can react to and we intend to react to.
That brings us to the end of this press briefing. This is a post-MPC press briefing for this month in September. And as is usual, as it was said in the press statement, the MPC shall be meeting again, and after that we shall have a similar press conference. For now, thank you very much for joining us, and we shall see you next time.